Listen, inflation doesn't care about your portfolio theory, your political opinions, or the narrative you're emotionally attached to. It only cares about one thing, whether the currency you're using to store value is losing purchasing power faster than your assets are compounding. My job isn't to protect your feelings, it's to protect capital. And I'm telling you now, if inflation keeps rising or stays structurally sticky, the investors who don't adjust their asset mix will quietly donate wealth to the system. I've seen this pattern before. Not once, multiple times. Different decades, different headlines, same mechanics. Most people misunderstand inflation because they treat it like a temporary price spike that will come back down if they just wait long enough. That's a comforting belief. It's also an expensive one. Inflation isn't just a CPI print. It's a transfer mechanism. It moves money from people who hold cash and long-duration promises to people who hold scarce assets, pricing power, and short-duration cash flows. And it doesn't relentlessly, 1 month at a time, until you either reposition or you accept the loss. You need to understand something very clearly. When inflation is persistent, the market doesn't reward optimism. It rewards correct exposure. Here's the philosophical framing that matters. Most investors treat inflation like a weather report. They want to know if it's raining today so they can decide whether to bring an umbrella. That's not how serious capital management works. Inflation is climate. It changes behavior, contracts, wages, politics, and interest rates. And once the climate shifts, assets don't all adapt at the same speed. The average investor makes two critical mistakes in an inflationary regime. First, they confuse nominal returns with real returns. If your portfolio is up 8% and inflation is running 6%, you didn't make 8%, you made 2% before taxes. After taxes, you may have made nothing. Second, they assume the central bank can simply choose to end inflation without consequences. People say rates will come down soon, as if that statement is a plan rather than a hope. Central banks react to inflation because they have to, but they also react to financial stability, unemployment, and government financing needs. When those objectives collide, the path is rarely clean. Now let me ground this in experience. I've watched the same movie in different formats. The late 1970s inflation regime, the commodity-led bursts, the post-crisis era where everyone believed inflation was dead, and the recent cycle where inflation came back and exposed how fragile safe portfolios really are when rates reset. The lesson is always the same. In inflation, the biggest risk isn't volatility. The biggest risk is being positioned for the wrong decade. If you're holding assets that only work when money is cheap, when rates are falling, and when the cost of capital is collapsing, then you're not investing. You're making a macro bet you may not even realize you're making. So let's talk about the core framework. This is where we get precise. When inflation keeps rising or stays elevated longer than markets want, the winners tend to share three characteristics. 1. They either have pricing power or they are directly linked to inflation through their revenue structure. 2. They have real scarcity, meaning supply can't be expanded quickly just because demand shows up. 3. Their cash flows are not excessively long duration. In plain English, you get paid sooner rather than later, and you're not relying on distant future promises discounted at higher rates. That's the framework. Pricing power, scarcity, shorter duration cash flow. Now I'm going to break down the asset categories that historically protect purchasing power while also being honest about their weaknesses. Because every inflation hedge has a price. The only question is whether you can afford it. Let's start with the first asset, high-quality businesses with pricing power. When inflation rises, the cost of inputs rises. Labor, shipping, raw materials, financing, everything. Companies that cannot pass those costs to customers see margins compress. That's not theory, that's arithmetic. But certain businesses are structurally positioned to raise prices without losing demand. Not because they're greedy, because the customer has limited substitutes, or because the product is a small percentage of the customer's overall budget, or because the brand and distribution are entrenched. In an inflationary world, I want businesses that behave like toll roads. They don't need to reinvent the product every year to justify higher pricing. They just need to remain essential. What does that look like in practice? It looks like consumer staples with strong brands. It looks like regulated utilities in certain environments, though you have to be careful because they're rate sensitive and often carry heavy debt. It looks like defense contractors with long-term government contracts. Again, watch the political risk and valuation. It looks like select healthcare businesses where demand is not discretionary. And it looks like parts of the energy value chain, where pricing is determined by global markets rather than local sentiment. But you need to be disciplined here. Inflation can lift revenue while simultaneously destroying profitability if costs rise faster than pricing. So I'm not talking about stocks go up because inflation. I'm talking about owning the subset of equities that can defend margins. The second asset class, real assets, starting with energy and commodities. Inflation is, at its core, a pricing phenomenon. Commodities sit at the beginning of the pricing chain. When commodity prices rise, they eventually show up in producer prices, consumer prices, and wage demands. That's why commodities can work as an inflation hedge. But here's the truth most people don't want to hear. Commodities are not an investment you can buy and forget. They're cyclical, politically sensitive, and mean reverting over long horizons. Commodities protect you during inflation shocks and supply constraints. They do not necessarily compound wealth over decades the way productive businesses do. They are insurance, often expensive insurance, because you pay for it through volatility and long flat periods. So how do professionals treat commodities? Carefully. They use them as a tactical allocation, not a religion. They focus on the structural setups: underinvestment, constrained supply, geopolitical friction, and rising demand from industrial reconfiguration. When those forces align, commodities can outperform dramatically. When they don't, commodities can waste years of your time. Energy is the most important commodity bucket because it's embedded in everything. If energy remains structurally tight, whether due to underinvestment, regulation, geopolitics, or demand growth, then inflation pressure stays alive. Energy is not just a sector, it's a cost structure for the entire economy. Now the third asset, real estate, properly understood. People love to say real estate is an inflation hedge, as if that's universally true. It isn't. Real estate hedges inflation under specific conditions. Rents can rise with inflation, occupancy stays healthy, and financing doesn't crush the owner. When inflation rises, interest rates often rise. Higher rates hit real estate through cap rates and financing costs. That can compress valuations even if rents are rising. So the inflation hedge can be real on the income side and negative on the valuation side, at least for a period. This is why I distinguish between real estate as an operating business and real estate as a leveraged duration asset. If you own real estate with long-term fixed-rate debt locked in at low rates, and you have the ability to reprice rents upward over time, inflation can actually work in your favor. Your debt gets inflated away in real terms, while your income adjusts upward. But if you're buying real estate at peak valuations with floating-rate debt, or you're forced to refinance in a higher-rate environment, inflation can destroy you. Not because the buildings are bad, because the capital structure is wrong. If you're holding real estate, or REITs, you need to stop thinking in slogans and start thinking in balance sheets. Debt maturity, fixed versus floating exposure, tenant quality, lease duration, and rent reset mechanisms. In inflation, financing terms matter almost as much as the property itself. Fourth, Treasury inflation-protected securities, TIPS. This is the cleanest, most direct inflation-linked instrument most investors can access. It's not exciting. It's not supposed to be. It is a mechanism designed to preserve purchasing power relative to CPI. But even here, you need to be an adult about trade-offs. TIPS protect you against inflation as measured by CPI. They do not protect you against the inflation you personally experience if your cost basket differs from CPI. They also can suffer when real yields rise. And taxes can complicate the realized return, depending on your jurisdiction and account type. Still, if you want a straightforward inflation hedge inside the sovereign framework, TIPS are one of the few instruments that explicitly adjust for inflation. In a regime where inflation is the enemy, that matters. Fifth, short duration, high quality fixed income. This is where most people get confused because they've been trained to think of bonds as either safe or useless, depending on whether rates are rising. Here's the correct way to think about it. When inflation rises, long duration bonds are fragile because their cash flows are far in the future and get discounted more aggressively. That's why long bonds can get crushed when rates reset. But short duration instruments, treasury bills, high-quality short-term notes, select money market exposures, can become valuable again because they reset yields faster. They give you optionality. They let you get paid while you wait. They reduce the opportunity cost of being cautious. In inflationary environments with higher rates, cash is no longer garbage. Cash becomes a strategic holding. If, and only if, the yield compensates you for inflation and you use it for timing and flexibility rather than complacency. You're not holding cash because you're afraid. You're holding cash because you want the ability to act when other people are forced to sell. Sixth, gold, correctly positioned. Gold is one of the most misunderstood assets in finance because people argue about it emotionally. They either worship it or dismiss it. I don't do either. Gold is not a growth asset. Gold is a monetary hedge. It tends to work when real yields are falling, when confidence in monetary discipline is deteriorating, when currency debasement becomes the quiet policy, or when geopolitical stress pushes capital toward neutral reserves. Gold can protect purchasing power in certain inflationary regimes, especially when inflation is rising but central banks are constrained from hiking aggressively, or when inflation erodes trust in paper claims. But gold can also go nowhere for long periods, especially when real yields are rising and the dollar is strong. So I treat gold like a reserve asset, an allocation that reduces systemic tail risk, not a magical wealth generator. If you want compounding, you own productive assets. If you want monetary insurance, you own some gold. Seventh, select infrastructure and real cash flow assets. There's a category that sits between equities and real assets. Infrastructure-like businesses with inflation-linked revenues. Think of assets where contracts explicitly adjust for inflation. Toll roads, certain pipelines, certain utilities, certain essential service networks. Again, not all of them. Many of these are debt-heavy and rate-sensitive. But when structured properly, these assets can generate resilient cash flows that keep up with rising price levels. The key is contract structure and balance sheet discipline. If the revenue resets with inflation, but the debt cost resets faster, the hedge breaks. Now let's talk about what does not save you when inflation keeps rising, because that's where the real damage happens. The first casualty is long-duration growth. If you're holding businesses priced entirely on future expectations, where the valuation assumes cheap capital and low discount rates, persistent inflation is hostile terrain. The math changes. The market stops paying for distant dreams and starts paying for near-term cash generation. That doesn't mean innovation dies. It means the price you should be willing to pay for innovation changes. The second casualty is passive exposure that assumes bonds always hedge equities. That relationship is regime-dependent. In a disinflationary world, bonds can rally when equities fall. In an inflationary world, bonds and equities can fall together because the discount rate is rising and margins are under pressure. If your portfolio is built on a single correlation assumption, inflation will eventually punish that arrogance. The third casualty is over-leverage. Inflation plus higher rates exposes leverage. The carrying cost rises. Refinancing becomes punitive. Cash flow becomes stressed, and forced selling begins. If you're holding assets that require low rates to survive, you're not hedging inflation. You're short volatility and long central bank support. Now I'm going to connect this to incentives because money flows are driven by incentives, not headlines. Governments run large deficits. Inflation reduces the real value of debt over time. That creates a quiet incentive to tolerate some inflation, especially when the alternative is austerity or explicit default. Central banks want price stability, but they also want financial stability, and they operate within political realities. If inflation is sticky and debt levels are high, the system is constantly balancing between tightening enough to control inflation and loosening enough to prevent something from breaking. That's the environment where inflation can persist longer than the average investor expects. In that environment, you want to own assets that the system can't print, can't easily replicate, and can't politically suppress without consequences. But you also want to avoid the trap of thinking inflation hedge means anything real. Bad assets are still bad assets. A weak business doesn't become strong because prices are rising. A poorly located property doesn't become desirable because CPI is hot. Inflation exposes quality. It does not create it. Now let me neutralize the common counter-arguments, because I know what people will say and most of it is recycled. The first objection: inflation is going to crash back down, so none of this matters. Maybe. But serious investors don't position portfolios on maybe. They position on probabilities and asymmetry. If inflation collapses quickly, many of the assets I've described still function. Pricing power businesses still earn, short-duration fixed income still provides optionality, infrastructure still generates cash flow. But if inflation stays elevated and you're positioned for a disinflationary golden age, then your downside is larger and more persistent. That's asymmetry. And I don't like asymmetry that's against me. Second objection: the Fed will just hike until inflation breaks. They can try. But the question is, what breaks first? Inflation, employment, the credit system, or government financing? The system is not operating with the same balance sheet it had decades ago. Debt levels matter. Interest expense matters. Political tolerance matters. You're not analyzing inflation in a vacuum. You're analyzing it inside a heavily leveraged economy. Third objection. Stocks always beat inflation over the long term. Some stocks do. The index, depending on valuation and starting point, can take a long time to recover in real terms after inflationary shocks. And taxes matter. Sequence of returns matters. Your personal time horizon matters. I'm not interested in slogans. I'm interested in protecting purchasing power over the next 12 to 60 months while still compounding intelligently over the next decade. That requires allocation, not ideology. Now here's the forward-looking warning. Calmly, without drama. If inflation keeps rising or stays structurally sticky, the next phase is not just higher prices. The next phase is second-order effects. It's wage pressure. It's political pressure. It's regulation. It's margin compression in weak businesses. It's refinancing stress. It's a higher default cycle in pockets of credit that were built for zero rates. It's a more unstable market structure where liquidity disappears when you need it most. And in that environment, the investors who get hurt are not the ones who were wrong on a chart. They're the ones who held the wrong duration, the wrong leverage, and the wrong assumptions about correlations. If you're holding long bonds because you think they are safe, you need to understand what you actually own. You own a fixed promise being eroded by inflation and repriced by rising yields. If you're holding speculative growth because you think the future automatically justifies any valuation, you're trusting the cost of capital to stay low. That's not a thesis, that's dependence. If you're holding cash earning nothing because you're waiting for certainty, you're accepting a guaranteed loss in purchasing power. What saves your money in inflation is not guessing the next CPI print. It's owning the right exposures, pricing power, scarcity, and cash flows that don't get destroyed by higher discount rates. That's it. That's the entire game. And the final piece, the controlled action. If you want continued clarity in markets like this, stay close to sober analysis and away from emotional narratives. Subscribe if you value unemotional capital preservation thinking, and watch the next episode because I'm going to get more specific about how I'd structure an inflation-resilient portfolio across equities, real assets, and short-duration income without relying on hope and without pretending risk doesn't exist.